Hello, class. This podcast is an explanation of the answer to our homework on cash flow for Kohl's that for this week. So I wanted to go over how that should have been done so you can make corrections. Remember that when you make corrections on your homework, for the best results, you want to explain what it was that you did incorrectly and why you're changing it. The idea is that by thinking that through after watching the corrections, you'll be able to create kind of study guide that you need for the exam by having not only the right answers but also the thinking behind those answers and the common mistakes, because my guess is that most of us will make similar mistakes, and learning from them is perhaps the best way to make sure that you understand this material. So, like we discussed earlier on the cash flow statement using the indirect method, you start with net income, you add back non-cash expenses is the first step, first change. And we have two here, depreciation expense and impairment is a non-cash expense as well. So both of those are going to get added up. Now we use the depreciation expense on the income statement. We do not use the change in accumulated depreciation on the balance sheet. It's just the depreciation expense. Then we add back losses or subtract gains, and we had one loss mentioned at the bottom of your income statement with a little note to the side about how that was calculated, and so that loss on sales added back. So those first three are non-cash expenses and losses. Then we look at our operating assets and liabilities, and the default is current assets and current liabilities are operating, unless you have reason to believe otherwise, which we did in this case, but we'll get to that in a minute. So we go down our balance sheet under the current assets, we find inventory, prepaid expenses, remembering that if an asset goes up, it is subtracted. If it goes down, it is added on that side to cash, because if it goes down, that means you got rid of it and changed it into cash. And if you went up, it means you spent cash to get it. On the liability side, it works just the opposite. We look at our current liabilities, and we go down, we do interest, all of these differences, with the increase being an increase in accounts payable being added to cash, because that's bills you do not have to pay, and decreases being meaning that you pay more, and so therefore cash goes down. And the oddball is deferred income taxes, because while it is a long-term liability on the balance sheet, it is a operating item and belongs in operations, and I made a note to that effect. Okay, so that was an exception, because what we're looking for is operating, not current and long-term necessarily. That's just the easiest way to find them. So under the investing section, and then here's, because it's positive, is cash flow from operating activities. Under the investing section, you got the sale and purchase of long-term assets. We sold the assets as mentioned in the note for 19. Other assets changed down by 2. And then the hard part is how much was paid for property, plant, and equipment. Up here, you'll notice my calculations on how to get that. Here's the beginning net property, plant, and equipment. It goes down because accumulated depreciation went up by the depreciation expense. We knew that from the income statement. It went down by the impairment. And it must have gone, this is the number we're going to come back and get figured out. We know that there it went down by 35. So the only number that would make this end up 8103 is 954. So if you take the 954 out, and this is all in formulas, you'll be able to figure out what the ending would be without the purchase of new assets. And then you can just plug in a number until you get the right ending net property, plant, and equipment. So that's how you get to the 954. You could calculate that as well a couple of different ways, but that's the basic idea. We had a purchase of treasury stock, which is a cash outflow. Dividends paid is calculated by looking at the change in retained earnings and comparing it to net income. Because remember, there are two things that change retained earnings: net income and dividends. Net income makes it go up, dividends makes it go down. So if the change does not match the amount of the net income, then the difference must be dividends. When you sell stock, you credit stock and additional paid-in capital. So the total of the difference, the change in that, is a sale of stock for cash, positive cash flow. There was a change in other long-term liabilities because financing section deals with liabilities and owner's equity. So assets, long-term assets here, equity and liability, long-term liabilities here. And then there was a little note that said that all of the payments on the capital leases from the year before, that which was called current liabilities, current portion of the leases, was paid. So 127 would have been paid out. So for liabilities, you have to note how much was paid out, as well as any new borrowings, which we did not have in this case, except for this other long-term liability. So here's your subtotal for financing, subtotal for investing. Both of those are negative, so the terminology that would use officially is cash used in investing activities. The change in cash, which we really should have calculated first, is 367. Beginning cash was 707, and it went up by 367 to get 1074. So this little reconciliation should go at the bottom of your cash flow. Sometimes there's also a reconciliation based on the foreign currency fluctuation, but we're not going to worry about that. And then the disclosures that should be on each cash flow are cash paid for taxes and cash paid for interest. And then any significant non-cash transactions in which we did not have. How do we get cash paid for taxes? Cash paid for taxes is the tax expense or provision for taxes on the income statement, plus or minus the change in taxes payable. Cash paid for interest is the interest expense on the income statement, plus or minus the change in your interest payable. So if your interest payable goes down, that means you paid more than the expense, and so you should add it. Right? If it goes up, then you should subtract it as far as the payable is concerned. So that's how you get those two disclosures on the cash flow, and that's how what your cash flow should look like.